It does take us to our talk of the tape. This new quarter for stocks with the economy, earnings, the election, geopolitics, very much on investors' minds. Let's bring in, for some answers now, one of this country's top investment advisors, Chris Toomey, Morgan Stanley Private Wealth. Welcome back. Good to have you. Interesting price action as this new quarter begins. Just what are your general thoughts on where we sit here in the markets?
You know, I think when we last spoke, we were a little concerned about September. We were really concerned about the fact that the market had pivoted where good news was good news, but bad news was bad news. And what was the Fed really going to do? And I think that was weighing on markets going into Fed week. I think the Fed giving that 50 basis point cut really kind of jolted into the economy, or into the markets, I should say, kind of a more stronger risk appetite. In our view, we think the economy is doing well, but we think a lot of this kind of euphoria is already probably priced into the market.
You think all the good stuff is priced in? Because, I mean, the Fed has just started cutting rates.
Right.
So some would suggest, look, just keep it simple, right? Fed's cutting, economy's good. Powell himself reiterated that yesterday to the degree at which he says, hey, we're going to go smaller than 50 because we can.
No, I mean, look,
what's wrong with that?
I think if you look at Q3 now that we're through Q3, what's performed really well? Tech's actually not performed very well, but things like utilities, REITs, financials, all up north of 10%, in some cases up almost 20%,
That's right.
So I think a lot of that euphoria about rates coming down has immediately been responding into those areas of the market. I think looking forward as to what we see, you know, we're entering the blackout period, so buybacks are starting to go away. Mm-hmm. We're starting to look at earnings expectations. Earnings now are priced to be about 2 times what historically they have been. And so in our minds, you know, you're right, the market is very resilient. I'm surprised, honestly, with how well it's doing today after what's happened in the Middle East. But that being said, we think at some point price is going to matter. We see earnings probably priced for perfection and a potential for a pullback.
Isn't there still a huge catch-up for all of these other parts of the market? I mean, just because the equal weight S&P outperformed the market cap weight in the third quarter doesn't mean it's done.
No, and I think that's probably the area where we're probably most constructive, right? So I think S&P 500 was up about 4 or 5%
relative to
market,
8%,
8 to 8.5%, right? So I think there are opportunities in that 473, as well as the fact that I think expectations for those types of companies are actually much more reduced than the Mag 7 and the names that have really been driving this market.
Let me ask you this: why aren't you just net? You know what? The game's changed a little bit. The economy's more resilient than most thought it would be at this point in time. Fed's cutting. They're just beginning. The trend on that is continuing to go lower. China's stimulus there. Mm-hmm. I mean, central banks are cutting all over the place,
right?
Or stimulating all over the place.
Well, and this is, I think, the difference between a question of what they want to do and what they need to do, right? So I remember when we were talking about the fact that economic data was getting weaker and the fact that the Fed
marginally.
Well, I mean, look at the labor market, right?
Look at the
labor
revisions in GDP. I mean, come on, look at the upward revisions in GDP.
But look at the labor market, right? And look at the fact that one of the key drivers with regards to why the economy is doing well and why inflation's going down is what? Oil prices and labor costs. Labor costs have been relatively going down, and oil prices have been stable, right? We're in a situation right now where we have this issue with regards to what's going on in the ports, potentially with regards to revisions with regards to labor. So I think labor is a key thing that we want to be focusing in on. The fact that China is accelerating could actually be a negative for the U.S. economy in the sense that if they're starting to draw more demand with regards to oil, granted Saudi Arabia is raising production, that could be an impact with regards to oil prices. So if you get oil prices going higher, you get labor being an issue with regards to labor costs going higher, that's going to affect margins, that's going to affect earnings, and that could be an issue if prices are too high.
I mean, there's a lot of ifs, could be's, and whatevers that people have been talking about for the last 18 months.